withdrawal of accommodation and an eye on crude as eye on inflation and pressures coming in the future, led maybe by crude or climate or a combination of both. That, to my mind, summed up in some sense what the policy looked like, but I'm sure there was more beyond it. And it's good time to get in a couple of experts to try and tell us what they thought of the policy and the commentary coming in from the MPC. Neeraj, Gambhir and Tanvee Gupta, Jain join us right now to talk about that. With me, of course, is my colleague Pallavi. Both of you, thank you so much for taking the time out and being with us. Neeraj, can I start off with you? What did you make of the action and the subsequent statements made by the Reserve Bank?
So first of all, it was a bit of a surprise. I think the consensus call was to have a 25 basis point hike and probably a change in the wording accompanying the policy. But I think we got the reverse. We got a pause, but the wording kind of continued. And a very clear communication that it is one policy at a time. So the governor went on to a long sort of explanation to say that it is a sort of a pause and not a pivot. The Deputy Governor Patra said that this current statement is kind of valid until 8th of June when the next policy is coming in. So I think it's very consistent with what we are seeing across the world from the central banks, that they are very unwilling to give any kind of forward guidance. They are taking it at one policy at a time or one event at a time, and they're looking at how the markets behave and what happens in terms of the markets, volatility, etc. Having said that, I think with this pause, the bar for the rate hike in near future is a little uncertain, maybe a little higher than what it was before, because the part of the inflation as projected by RBI itself seems to be inching towards 5.25%. And the market, we have a slightly different estimate, but it's kind of certainly below 6% threshold. And the fact that our growth is also kind of 6.25% range. So it's not as if we are in a very heated environment of economic growth. I think the one factor which kind of has played out quite well going into this policy is the fact that our current account deficit has narrowed in Q3 and Q4 of this year, and the forward forecast of next year for current account deficit is also quite benign. It is somewhere close to 2.25%. So I think that's one possible area where Reserve Bank would have gotten a respite, and hence they have used this opportunity to pause earlier than what the market thought.
Yeah, and also maybe the fact that he sounded fairly confident about the foreign inflows as well, talking about how the remittances have again gone back, and current calendar also seems to be positive out there. Thanks, Neeraj, for those initial thoughts. Tanvee, bring you in as well. Is this RBI trying to play the balancing act of making sure that there's an eye on inflation, but also trying to ensure that it does not do more harm to already a fragile growth environment?
Absolutely. In fact, I think we were also divided as a market whether they will deliver a hawkish pause or a dovish hike. And we were, kind of making a 60% probability of a hike. So definitely a positive surprise, especially from a market perspective. If you look at, the policy statement, I mean, there are a couple of points which RBI governor kind of highlighted. One is a readiness to act appropriately should the situation so warrant. The second very interesting analysis is so many times they mentioned in the statement about the global banking turmoil. And I think that is something which weighed on today's policy decision and presented kind of a trade-off between financial stability concerns and the conduct of a disinflationary monetary policy. So if we look at what was the biggest surprise for me was one, their GDP growth assumption. I mean, 6.4 itself was on a higher side, and they further upgraded the numbers by 10 basis points at 6.5. We are at 5.5. Consensus is at 6. So one really don't know, why such an optimism is coming on the growth front. However, they did tweak the inflation forecast marginally, but that was largely on base effect because the March quoted numbers came out to be much higher than what RBI would have estimated. If I look at going forward, I would say if I see what is going in RBI's mind, I think there are a couple of things where they are correct. One, when I looked at our inflation trajectory over the next 3 months, say, it is slowing down, it is softening to around 5% by the June 23 month versus a 6.4% number which we saw in the month of Feb. And this is partly on account of this correction in global commodity prices or the fiscal administrative measures taken by the government to cool off wheat prices. On top of that, there will always be a lagged impact of monetary policy inflation. Plus, we are seeing that there is a very favorable base effect at play. So on that basis, I think definitely the peak of inflation is behind us. Whether there are a lot of upside risk to inflation, whether it is on elevated core inflation or food inflation uncertainty on weather-related risk, I think RBI is kind of opened the path saying that we will be data dependent going forward. But at this point, there is no need for more rate action on part of the RBI.
Okay. Pallavi?
So, Tanvee, Neeraj also did touch upon what the governor had constantly emphasized, that this is a pause and not a pivot. But considering some of these factors you recently highlighted, considering the inflation forecast, considering the relief we're seeing on the external front, would it be correct to say that now on the conversation is more on, would you also believe that we're now looking at a period of extended pause and the conversation has now moved to when the RBI might have to cut rates, just keeping in mind whatever goes on globally?
Absolutely. In fact, if you look at our forecast, we are expecting a prolonged pause followed by 50 basis point rate cut later this year. So that was already in our numbers even before this policy. So we are estimating the 6.5% repo rate to go down to 6%. But this obviously is based also on the assumption that the Fed pivots, right? So my US global team, my US economist is expecting Fed to start cutting policy rates from the September policy. And we have, as of now, built in the first rate cut in the December 2023 policy review. In fact, we think that the Fed is nearing the end of the hiking cycle and the US economy likely to enter a recession this year. And this might open up space sometime, around the September quarter to start seeing a Fed pivot, which will be followed by the RBI. So yes, we are definitely in the camp that the terminal repo rate in India is closer to 6 and not closer to 6.5, 7.
All right. Before I move to Neeraj, I would also want to ask you a little bit more on inflation. Again, like we saw, despite the fact that the RBI did not choose to hike rates, the narrative remains that we're watching out, keeping an eye out on inflation concerns. And the commentary there was fairly hawkish. Did it in any way, did it send across a clear signal as to what the RBI is looking at this point? And what's your expectation on the inflation trajectory going forward?
So if you look at the RBI governor very clearly highlighted that whatever their forecast is based on current information. For example, they have taken oil to average at $85 a barrel. They are assuming normal monsoons, and they are assuming that there will be a lag of the monetary policy to inflation, which will help cool off the prices. If you look at the commentary, they also mentioned about intervention by the government. For example, we did saw FCI releasing the wheat stocks in the market, and that is also leading to a lot of correction in wheat prices, especially leading to fall in cereal inflation in the month of March. So I guess whatever is available information is what is actually getting incorporated in RBI's forecast. However, at this point, I see basically two upside risks to those numbers. One is an elevated core inflation, despite our forecast of 5.5% GDP, despite seeing that non-oil, non-gold, non-coal import growth is actually contracting. We are yet to see any significant softening in core inflation, largely because the input price pressure by the firms pass-through is still happening. And the second is a weather-related risk. I know if you look at the RBI press statement today, they are actually giving a very optimistic picture of the winter crop harvest. I hope that's true, but we did see unseasonal rains in the month of March. And as per media reports, there will be few states, including Punjab, that would have seen some effect. So eventually you need to see how the yield is going to be. And second is, if I look at most of the US Met Department forecasts, they are building in a high probability of El Nino conditions developing in 2023. Now, this is normally associated with deficient rainfall. This is not yet in my baseline, but if I even incorporate that, we start seeing some below normal monsoons in the second half of the monsoon season, say sometime in the months of August onwards, there still be good upside surprise on my food inflation forecast, which almost has a 46% weight in CPI. So I would say at this point, RBI forecasts are based on whatever is the current information, but as the factors change, as the global economies change, as the weather-related risks come to the forefront, I think numbers could also change going forward.
All right, Neeraj?
Yep. Neeraj, coming coming back to you, what does this do from a market's perspective per se? Because, like you said, the surprise is the fact that it's not a hike and a dovish statement, but a pause and a statement which wasn't exactly dovish, if you will. If anything, you could almost classify the statement as being slightly cautiously hawkish, if you will. So, what does this do to the markets, you reckon?
So I think the market is going to assess what is the probability of rate hikes in near term and what are the conditions that could lead to a further rate hike. I don't think the market is currently talking about a rate cut. I don't see it any of the curves market pricing in a rate cut. So even though economists have penciled in some rate cuts, market pricing is not there. Unlike in US, where the market pricing is there, but the economists are a bit mild in terms of what rate cut could happen. So it's the situation in India is reversed. I think as time progresses, we will see what is the next step from RBI. Is it a continued path, or is it at some point in time, if the inflation does not follow the trajectory that everybody is expecting, or there is a negative surprise on the external front and rupee comes under pressure, and that could push Reserve Bank to rethink about the pause. Till such time, I expect a very range-bound bond market. In fact, on the longer term, we've seen already about 6 to 8 basis points reduction in yields. We will continue to see that. Bear in mind that we are starting with the new year calendar. Borrowing program is starting effective this week. So that will also have some bearing on the market. So I'm not anticipating a very rapid sort of reduction in yields. The place where we are seeing a meaningful impact on the yields is in the short term and the money market rates. Short-term money market rates had gone up to, for example, 1 year T-bill was at its peak at about 740, came off to 7.25. I think with this movement, there is a considerable scope for short-term rates to come off meaningfully rather than long bond yields to actually come off. So I think it's in general positive, but it will be a bit of a slow process.
Okay. Last question from my end, Neeraj, and that is, would you have expected something more? I mean, there have been people who've spoken about how corporates for the last 2 months have been complaining about the liquidity stress in the system. There's some stress on the air conditioning at Tanvee's end, maybe. But Neeraj, liquidity stress in the system, you reckon some tinkering should have been done there? No.
No, I wouldn't call it a stress. I think it's a seasonal tightness that we go through in the month of March, because that's the year end and everybody's sort of trying to close their books. And that has some impact on the money market liquidity. Over the last 2 weeks, we've seen a considerable amount of spending happen from the government. So that has basically meant that liquidity has come back into the system. Market is kind of hoping that Reserve Bank provides a reasonable amount of liquidity to the system. We know that we are in a tighter monetary policy regime, so we're not going to have the same level of liquidity that we had, say, 12 months ago. So I think market is hoping that Reserve Bank will continue to provide the amount of liquidity that the system requires for credit to grow at about 15%. That would mean that at times Reserve Bank doing, for example, reverse repo and repo operations particularly closer to the repo rate, so that the overnight rates are well anchored at around 6.25 to 6.5, and they don't kind of go higher. So I think as long as that happens, and as long as the system remains mildly in surplus, I think we're okay from a liquidity standpoint.
Okay. I'm done. Pallavi, any last questions?
Okay, closing question. So Tanvee, you did lay out some of the downside risks in the domestic economy. And the RBI did today continue to emphasize on financial stability, keeping in mind whatever we've seen in the global banking scenario the last few weeks. But what about other global external risks? The RBI did not seem to elaborate as much on that. Whereas we have been talking about the downside risks to the domestic economy, firstly from global risks, and secondly from the lagged impact of monetary policy. What are your thoughts?
Sure. So if you look at what is happening in the financial markets, I would say this volatility which you are seeing because of global, banking turmoil has significantly clouded the economic outlook. So at a minimum, what you're seeing globally is that the bank lending conditions are likely to tighten further. But as you're seeing even in India, the growth impact could be partly offset if the central bank reduced the intended hiking cycles. But at this point in time, I would say as the global lending conditions tighten, it will lead to some impact in terms of the tightening financing conditions itself in India. So while we are expecting the direct impact of a turmoil in European or banking sector stress to be very limited on India, I think there will be an impact in terms of tight lending standards. So if I do the sensitivity analysis, I would say that versus a 100 basis point slowdown in US and EU GDP growth, which call it a G2 GDP growth, the spillover impact on India amongst most of the Asian economies or emerging market economies are one of the lowest. So every 100 basis point slowdown in US and EU GDP growth will bring down India's GDP growth by roughly around 40-45 basis points. So I would say India is one of the low beta economies, but where we would see the impact is via more financial flows, trade flows, etc. So in our base case, we are expecting US economy to see a hard landing, move into recession later this year. China is doing well, but yet we have not seen the China imports doing really strong, which will have a multiplier impact on other economies yet. So that is kind of an offset factor to the global growth environment. So I would say at this point, the global headwinds remain a bigger concern than the domestic economic situation. Purely on domestic macro stability risk, I think as Neeraj was pointing, they have eased significantly. We are estimating current account deficit to ease to 1.5% of GDP, well below the sustainable range of 2.1 to 2.3. Inflation, yes, is going to remain below the upper threshold of CPI. What RBI has a band, but not really going back to the medium-term target of 4% anytime soon. So I would say in terms of domestic economic environment, we are seeing a slowdown, but I think India is still seeing a limited spillover impact.
Great. Well, both of you, thank you so much for taking the time out and being with us today. Really appreciate your time.
Yeah. Thank you. Thanks for having me.
Yep, the pleasure was ours. Viewers, thanks for tuning into this broadcast.